You are listening to the MetaPropCast, the podcast of innovation and technology in real estate. I'm your host, Phil Russo. And don't forget to subscribe to the MetaPropCast on SoundCloud, YouTube, Twitter, and metaprop.org. Welcome to the MetaPropCast, the podcast of innovation in real estate and technology. We're really happy to have one of our close friends here today, Zachary Ahrens, founding partner of MetaProp NYC and project manager with Millennium Partners, a leading national developer. Zach, welcome.
Thanks for having me, Phil.
So, how did you become the biggest PropTech angel investor in the world?
Well, it's very sweet of you to refer to me that way. I'm certainly not the largest in terms of dollar amount, but I certainly, for a long period of time before starting MetaProp, was most likely the most active angel investor in the PropTech space in terms of number of deals that I did. It's kind of a circuitous story how I arrived at doing this. You have to go back with me to about 2010. And in 2010, I was winding down my walking tour business, which I ran. I'm still a licensed tour guide, by the way, if any listeners out there want a walking tour of an historic New York City neighborhood, we can chat about that. But I was getting very interested in technology, mainly as a vehicle for putting some of my tours onto an iPhone. I had a vision that in the future, physical tour guides might be obsolete, and that most people would do their tours, whether it be audio or video tours, on their smartphones. So I tried to build a lot of technology around that, and I failed miserably. And instead of continuing to spin my wheels and build technology myself, I decided that I might be better off investing in similar types of early stage technology products, entrepreneurs who were better than me at being entrepreneurs, who were building products in a similar vein to what I wanted to build, but for whatever reason couldn't build. So I started angel investing in those types of businesses, mainly mobile applications for walking tours and finding restaurants and finding information about local data and cities. And through that, I got I went down a pretty large rabbit hole into the entire technology space. And I started interning at a venture capital fund that actually focused on the type of mobile technology I was interested in. It's called ENIAC Ventures. I then became an LP of that fund. Those guys taught me a lot about the venture capital business. And while this was going on, my father hired me to help him out with a project, a Millennium Partners project that he was working on in Hollywood, California, called Millennium Hollywood. And what my dad does specifically is work on entitlements for large-scale mixed-use urban developments. And the old school way of doing community engagement through a real estate entitlements process is all physical. It's all done in dingy church basements. You go and you meet with the community, you present the project, and they ask you questions, they suggest changes, they tell you they hate it, whatever it is. That's how things have been done for decades and decades in the business. My father, being a visionary in this space, realized that social media and event marketing and content marketing were going to become increasingly important in order to galvanize people's support for large-scale real estate projects. And he believed that most millennials would not want to sit in these church basements, but they would be willing to and actually excited about engaging with a real estate development project if they were able to engage with it on their own time online. And because for my walking tour business, I had done quite a bit of social media marketing and content marketing and event marketing, he hired me to go out to Hollywood and create a program where we would do just that. We would present a project to millennials online. This was in 2010. Many people that we spoke to in the real estate business didn't even know what Facebook was. let alone what PropTech was. They were highly skeptical that we could succeed at galvanizing this type of support, but we launched it anyway, and we proved people wrong, and we ultimately got our entitlements in 2013. And a large part of that was due to the massive groundswell of support that we were able to achieve, specifically from millennials who were mainly engaging with the project online. So after our success with that, my father and I decided that we would look at not just the community engagement part of the real estate process, but that we would look at everything we do in real estate and figure out how technology could benefit it, could make it faster, better, and cheaper. So we started looking at different technologies. We started investing in different technologies. And around this same time, I was at business school, and I had a professor named Stuart Ellman, who's one of the founding partners of RRE Ventures here in New York City. And he asked me to write a final paper, and I sent him the topic I was interested in. And he told me the topic I chose was absolutely horrible and really, really dumb. And he said, "Don't you work at a real estate company?" And I said, "Yeah, I work at a real estate company." He said, "Well, I think real estate technology over the next 5 years is going to be huge, and I would like you to educate me on it, so do some research on it." So I did a bunch of research. I wrote my final paper for his class, and that was really my first foray into this space. Once I'd started doing a lot of research, I realized how big an opportunity this could be, and how things were going to change over that cycle. At this point, it was 2011. The cycle was kind of just beginning. And so I decided to devote my entire angel practice, more or less, to PropTech. And I stopped looking at any other type of early stage business. I looked at only PropTech and architecture, engineering, construction technology. And I very aggressively made over 60 investments in a couple years. And that caught the attention of Aaron Block and Clelia Peters. And in 2015, they offered me the opportunity to partner with them and kind of institutionalize what I had been doing for a few years prior to that. And that was a very enticing opportunity. So fast forward, we're now in 2017, and that was pretty long-winded, but I think circuitous, long-winded, but hopefully potentially interesting for the listeners.
Definitely interesting. And today, having given us that really interesting runway to where we are now, has PropTech investment become a thing for more general technology venture capitalists?
Yeah, so Sand Hill Road has always had an interest in PropTech, really since Web 1.0. You saw a lot of the old legendary firms in the Valley, most notably Trinity Ventures, but also Benchmark, Sequoia, TCV, and many others started investing in PropTech in the 90s with deals like LoopNet, Zillow, Trulia, and some others. As I wasn't really around then. I was still in high school at the time, so I'm not sure whether when they were making those investments, whether they were making them as saying categorically we want to get exposure to PropTech, or saying this is a really interesting company with a really great team and a great product in an underserved space. It's kind of hard to tell. But what I would say now in this cycle, as we're kind of reaching the crest of this wave of PropTech, traditional venture capitalists are devoting a lot more capital to it. It's no longer a fringe thing. I speak to a lot of both senior and junior people at these funds, and in many, many cases, you're seeing partners getting very interested in this space and actually tasking junior people, principals, and associates with 3 to 6 month research projects about which submarkets within PropTech they should be investing in. So it's certainly not a new thing for these funds, but I would say it's become more of a institutional thing, more of a research focus for them. But they've always been doing deals in the space, and in some cases, especially LoopNet, Zillow, Trulia, very successfully so.
So about the middle of last year, you predicted more M&As, faster growth in PropTech by the end of the year and into 2017. Well, here we are, and VTS and Hightower merged. Opendoor has a $1 billion plus valuation, and Floored was just purchased the other day by CBRE. What did you see in the market that led you to your insights on PropTech's reaching a growth tipping point?
There were a few things colliding that made me make that now thankfully correct prediction in hindsight that M&A was going to rise quickly and companies were going to become more acquisitive. One major factor is just macro cycles. Typically, when you're nearing the peak of a cycle in any business, not just PropTech, you see massive waves of consolidation in general. 2016 saw a lot of deals across multiple different industries. Why that is that at the end of a cycle, typically companies who otherwise would have invested in their own internal projects to generate growth, or invested in buying back shares, or given money back by increasing dividends, chances are they've already done all of those things. So they've already initiated share buyback programs, already increased their dividends. They have already undertaken all of the major strategic initiatives that they wanted to for that cycle. So the only way to grow at that point is M&A. Other macro factors that bolster the M&A market right now are, one, the almost certainty of rising interest rates, which makes borrowing costs for cash deals much more expensive. So if you're a company looking to buy another company with cash right now, you are looking to do that sooner rather than later, because chances are you're not funding that entirely off your balance sheet. You're going to borrow some money to pay for that, and you want to borrow money, obviously, when rates are still low. So that's factor number one. And then factor number two, the other way public companies and private companies acquire other companies is through stock deals. And you had a situation where both in the private market, and you still do, and in the public market, you have very, very high multiples. You have high revenue multiples, you have high PE multiples, and you have high EBITDA multiples. So that means companies have vast currency in their stock to go out and buy other companies. So that's the macro reason why I saw M&A happening. Micro, as it relates to PropTech, I would say there are two types of M&As that we're seeing right now. One is straight up mergers between young companies, and the other are established incumbents, whether they're incumbent PropTech companies or incumbent real estate brokerage and services companies buying smaller nascent companies. On the straight up merger side, you have situations where a lot of companies were coming out with very, very similar products and going after the exact same customer base, more or less. And when two or more companies are doing well, are funded by venture capital, building very similar products, going after similar customer bases, a lot of that venture capital money inevitably gets wasted just by going toe-to-toe and trying to outspend your competitor on marketing, on sales, on events, on product development, when that capital should really be spent growing the business, listening to customers, iterating on product, and then developing entirely new product suites. So in the case of Hightower VTS, which was probably the most notable merger in our space in 2016, that was really the impetus for it. Was you had two companies, they were going head to head for many years with similar products, similarly talented teams, very similar customer bases, and it reached a point where instead of trying to kill each other, they just decided to merge and own the whole market. Kind of similar to another blockbuster CRE tech deal from the Web 1.0 era, when CoStar finally just decided to buy LoopNet after many years of fighting and litigation and things like that. The other side of M&A, which is more large incumbents purchasing smaller companies, I look at that phenomenon slightly differently. One is large incumbents, when you have the threat of really fast-moving, well-capitalized startups that are becoming bigger, better capitalized, and more mature, I guess you could say. For example, Hightower VTS. If I were a CEO of an incumbent PropTech company, take any public or large MRI, RealPage, Yardi, JD Edwards, I would be nervous about what's going on in the startup world, and I would want to buy as many small companies as I can through tuck-in acquisitions to ensure that my moat is as protective as I believe it is, and that my customers won't leave me for some flashy looking startup. So I predict we're going to see a lot more of the big tech incumbents buying smaller companies. The other piece of that equation is the services and brokerage businesses stepping up and becoming acquirers. Kind of started with JLL buying Corrigo, but most notably, very recently, CBRE stepped up and bought Floored. They're buying for slightly different reasons. What the advisory and brokerage businesses have learned over the past few years is that technology companies trade at revenue multiples and services companies trade at EBITDA multiples. And so if you can morph your service business into a technology business, similar to what Compass has done for residential brokerage, and what one of our companies, many of our companies are doing in for example, Spruce in the title space and Bowery in the appraisal space. If you can become a tech-enabled brokerage or a tech-enabled advisory firm, chances are Wall Street is going to peg you with a much higher multiple than you would ordinarily. And then plus it's really good for things like recruiting, new talented employees. It's important for employee retention. Your company is all of a sudden viewed as innovative and cutting edge, and your clients like it. It's a tool, it's a marketing tool to go out and land more landlords and real estate investors as clients if you have a huge stable of technology businesses that you've been rolling up.
We are speaking with Zach Ahrens, founding partner for MetaProp NYC and project manager at Millennium Partners. Zach, let's walk over now to the advertisements for myself department, as Norman Mailer called it. Let's talk about MetaProp NYC a bit, which, as you mentioned, you co-founded with Aaron Block and Clelia Peters in 2015. We talked a little bit about what made it a good idea then. Now it's grown to a fund, an accelerator, an advisory business. That's a large and varied platform. How would you describe the business today and going forward? What's MetaProp's value add?
That's a great question. We started this company because we were shocked that there was no central location in New York City where technologists and entrepreneurs could go and have dialogue with real estate executives. People were looking to build companies in the PropTech space. They were going about it all wrong because they just weren't talking to people in the space, not because they didn't want to, they just couldn't quite get to these people. And vice versa. There were a lot of real estate people who had really good ideas, but really had no idea how to build and scale technology infrastructure. So we created this company to serve as we always throw around the word nexus, information hub, gathering place. And we thought that the best vehicle for that would be a PropTech specific accelerator program. So we started the accelerator program in 2015, and we quickly realized that we had a sweet spot in the accelerator business where we could take a company that already had a product, so maybe even had gone through a more general accelerator program like Techstars, YC, AngelPad, you name it, before, and was really in need of figuring out how to tweak their pitch to potential customers. And we were able to provide both coaching, which was really, really fun and surprisingly challenging for us and for the entrepreneurs to get some of the non-real estate entrepreneurs to speak real estate. And then we could provide the introductions to people who would serve as customers of theirs. The issue with the accelerator was we couldn't work with as many companies as we wanted to. We couldn't work with companies that were napkin ideas with that business model because it was so geared toward companies that had products that were just looking to accelerate their growth in sales and business development. So at the end of 2015, we started our fund business in order to deploy across the real estate value chain So we wanted to tackle every asset class within real estate, residential, multifamily, office, retail, parking, hospitality, storage, industrial. Then we wanted to target every single task that a landlord, broker, property manager, facilities manager, loan officer, appraiser, etc. would do during their days, and try and make their jobs faster, better, easier, cheaper. So that's kind of how the fund came about. We had a lot of people in our network who really started as mentors for the accelerator, who wanted to get involved out of just general intellectual interest, who wanted exposure to these companies. They wanted an early look at things that they could adopt for their own real estate businesses. And then as we continued to talk to more people like that, we saw a huge hole where a lot of real estate companies, both large and small, didn't really have a handle on what technology they were using. They didn't have an idea of how the disparate technology platforms they were using could be integrated with each other, how data sharing between different departments within a real estate organization could occur and benefit the organization. And they also didn't know, they had no screen for new products. So their default response when they were approached with something was no, just because they were approached so much and they were not sophisticated enough necessarily and didn't have the time to separate the wheat from the chaff. So we brought on this killer guy named Phil Russo, and we started the advisory business, and that business is set up to help large companies figure out some of these issues that are really pervasive in the industry. So, we're now lucky enough to be in a position where we can help companies that are 2 people in a garage, all the way up to companies that have thousands of employees globally. But it's all focused on figuring out how to grow NOI using technology. That's really what it boils down to. So our value add to startups is we teach them how to present how they grow NOI to landlords. And our value add to landlords is that we show them what technologies they should be using or how to think about technology in a way that grows their NOI.
Okay, let's go now from the self-promotion area to a little more of a pop quiz on what's happening throughout the PropTech startup landscape globally. Do you think we're going to see more companies starting up? We've seen an increase year over year, or are we going to see some bubble bursting in the next year or so?
I think you'll see bubble bursting at later stages, not at the seed stage. The bubble bursting phenomenon is more going to be a gradual deflation than a burst. There are a handful of companies nationwide and worldwide that have raised a huge amount of money over the past few years and are just not going to live up to the promise. So those companies won't be able to raise follow-on financing, and they'll either be purchased by large incumbents, merge with other startups, or disappear. At the very early stages, I think the trend is going to continue to increase. I think you're going to see more and more companies globally. This phenomenon is becoming very big in places like Europe, Southeast Asia, South Asia, really almost all over the world. We're seeing companies in South America and Central America popping up, Canada, Australia. So it's so cheap to start a company now. I don't see the sheer number of companies declining. I see it increasing. We're now tracking a few thousand companies globally in our proprietary database. I would bet that number doubles within the next 3 to 5 years. It's just so inexpensive with Amazon Web Services, co-working. You don't really need all that much money to start a company. Whether the quality will increase with the size, I don't really know. I hope so, but we're very choosy about the investments we make for both the fund and the accelerator. We look at probably 3 to 4 deals a week, and I would say we do 1 deal a month. So we're pretty picky. So it's not going to impact us very much, whether it goes from 3,000 to 6,000 or 3,000 back to 2,000.
Last question. What's the next big thing in PropTech, even if it's a small thing that you're looking at?
There are a lot of next big things. We are on the cusp of artificial intelligence entering PropTech for the first time in a meaningful way. I think over the next few years, you're going to see the emergence of artificially intelligent asset managers, property managers, which kind of scares me because that's a big part of what I do at Millennium. You know, if we can invest in artificial intelligence to replace me, you know, I'll be upset that I lose my job, but hopefully the robot, the benevolent robot taking my job, I'll have some sort of equity, financial interest in that benevolent robot, so I won't be so upset about it. So I think AI is going to absolutely explode. I think autonomous vehicles, while not a real estate technology phenomenon per se, are going to have massive impacts, not just on the PropTech space, but on the real estate space in general, in how people perceive about where they live and where they work. So that's coming, and I believe it's coming faster than most people think. You're going to see a huge amount of innovation in how buildings are physically built. Autonomous construction vehicles are here. They're going to continue to proliferate. Adoption is going to increase. You're going to see 3D printing of high-rise concrete structures, which will completely change the way people think about how buildings get built, change the speed, change the way construction crews work. You're going to see a huge adoption of blockchain technology for real estate conveyance, purchase and sale, title business. We're seeing already adoption of blockchain technology in Cook County in Chicago. In the Republic of Georgia is doing a program nationwide. That's just going to continue to accelerate. And then also virtual reality. It's not a coincidence that the first deal of 2017 was Floor, which is a virtual reality company, getting bought by CBRE, which is the biggest real estate service provider in the world. VR is going to be the way that people engage with real estate. It's going to become very, very different when VR reaches the tipping point where you're unable to determine whether you're actually on the site physically inspecting or whether it's just some combination of virtual reality and drones that are doing it for you while you sit at your desk or you sit on a beach somewhere. So those are the major things we're looking for. And then we're looking for interesting software platforms in super unsexy spaces that haven't been touched in decades. So surveying is one that I'm looking at. So if there are any listeners out there who have a surveying software company, please let me know about that.
MetaProp NYC founding partner and project manager at Millennium Partners. Zach, it's been great talking to you. Thank you very much for your time.
Thank you, Phil.
Take care. This is Philip Russo. Thank you for listening.